The Australian dollar against the US dollar, known simply as the Aussie, is one of the most traded currency pairs in the world, and for good reason. It has clear drivers, strong liquidity, and a tendency to trend. If you are looking for a pair worth understanding, this is one of them. First, the basics. In Forex, currencies trade in pairs. The first currency is the base, the second is the quote. In AUD, the Australian dollar is the base. So if the pair is trading 0.650, 1 Australian dollar buys 65 US cents. Simple enough. What makes this pair interesting is what moves it. Australia's economy runs heavily on commodity exports, iron ore, coal, and gold chief among them. When demand for those commodities rises, particularly from China, Australian export revenues tend to go up. That increases demand for the Australian dollar, and the pair tends to move higher. So when you trade the Aussie, you are not just watching two countries, you are watching global commodity markets too. China deserves special attention. It is Australia's largest trading partner by a wide margin. Strong Chinese economic data, manufacturing figures, GDP growth often signals higher demand for Australian raw materials. That means news out of Beijing can move this pair, even when nothing is happening in Sydney or Washington. Interest rates matter just as much. When the Reserve Bank of Australia raises rates, foreign capital often flows into Australian assets, lifting the Australian dollar. When the US Federal Reserve raises rates, the US dollar tends to strengthen, pushing lower. Rate decisions from both central banks are events worth having on your calendar. The Aussie also responds to risk sentiment. In confident markets, when investors are willing to take on more risk, commodity-linked currencies like the Australian dollar tend to perform well. When uncertainty spikes and investors move towards safer assets, AUD can fall quickly. That broader market mood is always worth tracking. On the technical side, this pair is known for trending. Moving averages, support and resistance levels, and momentum indicators can all be useful tools. Identifying the direction of the trend before entering a trade is a sensible first step. For liquidity, the best hours to trade the Aussie are during the Asian-London overlap and the New York session when US data drops. Spreads tighten, orders fill cleanly, and price action is more reliable. One thing worth saying plainly, trading involves real risk. Leverage amplifies both gains and losses, and most retail traders do lose money. Only trade with capital you can afford to lose, and always define your exit before you enter. If you want to practice with the Aussie before risking real money, a demo account at ZenithFX.com lets you trade live market conditions without any capital on the line.